Welcome to new video lessons of CFA Learning. Study session number 4, reading number 1. Today's topic is economic growth and the investment decision. Before get started, subscribe our channel and hit the bell icon to get the latest videos. First, let's learn the economic growth and investment decisions. Equity prices reflect expectations of the future stream of earnings, which depend on expectation of future economic activity. Shorter-term relationship B/W actual and potential growth is a key driver of FI return. Over long periods of time, the actual growth rate of GDP should equal the rate of in potential GDP. 2. Growth in the global economy, developed vs developing countries. Economic growth equals annual percent in real GDP or in real per capita GDP. Growth in real GDP reflects how rapidly the total economy is expanding, while real per capita GDP reflects the average standard of living in each country. Using market exchange rate to reflect GDP into another currency has two problems. Market exchange rates are very volatile. Market exchange rates are determined by financial flows and flows in traded goods and services. Ignore consumption for non-tradable goods and services. 2.1 Savings and investments. Problem of developing countries. Savings converted to investment, then GDP growth, then income, and in last in savings. 2.2 Financial markets and intermediaries. Role of financial sector refers to channel funds from savers to investment projects. Financial markets can promote growth in at least 3 ways. 1. By screening those who seek funding and monitoring those who obtain funding. 2. By creating attractive investment instruments. 3. Existence of well-developed financial markets. 2.3 Political stability, rule of law and property rights. Key ingredients for e.g. an effective and stable government. A well-developed legal and regulatory system. Clearly established property rights. 2.4 Education and healthcare systems. Brain drain and inadequate education are major impediments to growth for many developing countries. Allocation of education spending among different type and levels of education is a key determinant of growth. Poor health is another hindrance to growth in the developing countries. 2.5 Tax and regulatory systems. Limited regulation, entrepreneurial activity, and the entry of new companies' production level. 2.6 Free trade and unrestricted capital flows. Open economy, world savings can finance domestic investment, domestic income, savings and investment. Foreign investment can occur in 2 ways. Foreign direct investment. Indirect investment through purchase of securities. 3. Why potential growth matters to investors. Potential GDP, maximum amount of output an economy can sustainably produce without inducing an inflation rate. If the ratio of corporate profits to GDP is trending upward, earning growth, GDP growth, but it's not sustainable. The relationship B/WEG and stock price can be examined through an equation, where T equals time horizon, %P equals percent in stock market value, E equals earnings. Short to intermediate horizon interpretation. All 3 factors contribute to appreciation or depreciation of the stock market. Long run interpretation. Growth rate of GDP dominate. Second and third terms of equation must be approximately 0. E.g. estimation is also relevant for global FI investors. If current GDP is greater than potential GDP, it equals to inflationary pressure and then pressure on nominal IR and bond prices. Potential GDP improved credit quality. FI investors must closely monitor the output gap and growth rates of actual and potential GDP to assess the likelihood of in central bank policy. Credit rating agencies use potential GDP growth to evaluate the credit risk of sovereign debt. 4 Determinants of economic growth. 4.1 Production function. Production function Y equals AF, KL, where Y equals level of aggregate output, L equals labor quantity, K equals capital stock, A equals total factor productivity. Unless stated otherwise, the level of technology should be interpreted as referring to TFP. Cobb-Douglas production function, equals, where alpha equals share of output paid by companies to capital and labor, value B/W 0 and 1. Properties of Cobb-Douglas function. Constant returns to scale. Diminishing marginal productivity with respect to each individual input. If value of alpha close to 0, diminishing marginal returns to capital are very significant. 4.2 Capitals deepening versus technological progress. Capital deepening and in the capital to labor ratio. The ratio will as long as growth rate of capital growth rate of labor. When marginal product of capital equals marginal cost profit maximizing producers will stop adding capital. When marginal product of capital equals marginal cost profit maximizing producers will stop adding capital. 4.3 Growth accounting. It states that growth rate of output equals rate of technologies plus alpha times the growth rate of capital, 1a, times the growth rate of labor. Sustained growth in per capita output requires progress in TFP. Data on output, labor, capital and elasticity are available in developed countries, but data on technological must be estimated. It estimates the technological contribution progress to e.g. used to empirically measure the sources of growth in an economy. Used to measure potential output. Alternative method of measuring GDP. Labor productivity growth accounting equation. Growth rate in potential GDP equals long-term growth of labor force plus long-term growth of labor productivity. Disadvantage TFP and capital deepening are difficult to analyze and predict over long run. 4.5 Natural resources. Renewable resources. Resources that are replenished, such as a forest. Non-renewable resources. Finite resources that are depleted once they are consumed. These resources eventually limit growth. Ownership and production of natural resources is not necessary for a country to achieve a high level of income. Presence of natural resources may restrain growth mainly due to two reasons. Countries with natural resources may fail to develop economic institutions necessary for growth. Dutch disease currency appreciation driven by strong export demand for resources making other segments of economy globally uncompetitive. 4.6 Labor supply. Labor force equals working age population, 16 to 64 years, that is either employed or available for work. Following are four factors that contribute to growth in labor input. 4.6.1 Population growth. It is determined by fertility rates and mortality rates. Long-term labor supply is largely determined by the growth of the working age population. The age mix of population is also important. Percent of population 65 years and 16 years is a key consideration. It has no effect on growth of per capita GDP. 4.6.2 Labor force participation. Percent of the working age population in the labor force. In the short run, differences in labor force and population growth rates may be due to changes in the participation rate. And in the participation rate may the growth of per capita GDP. 4.6.3 Net migration. Immigration is a possible solution to the slowing labor force growth being experienced by many developed countries. Low birth rates. 4.6.4 Average hours worked ION. Average hours worked is highly sensitive to the business cycle. Long-term trend towards shorter work week in advanced countries. 4.7 Labor quality, human capital. Human capital accumulated knowledge and skills that workers acquire from education, training, or life experience. Better educated and more skilled workers more productive and more adaptable to changes in technology. Investment in education and on-the-job training, a significant return on that investment. 4.7 Labor quality, human capital. Human capital accumulated knowledge and skills that workers acquire from education, training, or life experience. Better educated and more skilled workers more productive and more adaptable to changes in technology. Investment in education and on-the-job training, a significant return on that investment. 4.8 Capital, ICT and non-ICT. If gross investment less DEP of capital is zero, the physical capital stock from year to year. The correlation B/W economic growth and investment is high and plus VE. Network externalities computers allow people to interconnect through the internet and by email, enabling them to work more productively. Know of people in network greater the potential productivity gains. High level of capital spending on non-ICT should eventually result in capital deepening and thus have less impact on potential GDP growth. Level of productivity depends on accumulated stock of human and physical capital. Permanent in rate of labor productivity growth, sustainable e.g., upper bound for earnings growth, potential return to equity and vice versa. 4.10 Public infrastructure. Public capital roads, bridges, municipal water dams and electric grids, in some countries. The full impact of government infrastructure investment may extend well beyond the direct benefits of the project. 5 Theories of growth. Referred as Malthusian theory focused on the impact of a growing population in a world with limited resources. Production function labor input with land is a fixed factor. Key assumption: population growth accelerates when the level of per capita income rises above the subsistence income, minimum income needed to maintain life. The labor input faces diminishing marginal returns, so the additional output to zero and per capita income returns back to subsistence level. Constant standard of living and no growth in per capita output in the long run. According to this model, the adoption of new technology results in a larger but not richer population in the long run. The prediction from model failed for two reasons. One is the growth of per capita income. Population growth slowed rather than accelerating as predicted by classical model. 2. Growth in per capita income has been possible, as rapid technological progress offset the impact of diminishing returns. 5.2 Neoclassical model. Objective of neoclassical growth model: determine the long-run growth of output per capita. The Cobb-Douglas production function is the heart of this theory. 5.2.1 Balanced or steady state rate of growth. Steady state rate of growth occurs when the output to capital ratio is constant. The growth rate of output per worker. Delta equals delta 1 plus delta 2. Equilibrium output to capital ratio, denoted by the constant equilibrium, where it is equals growth rate of TFP. S equals saving. Underscore equals growth rate of labor productivity. N equals growth rate of labor. Delta equals depreciation rate. In the steady state, capital to labor ratio, K, and output per worker, Y, grow at the same rate, given by marginal product of capital equals real interest rate. Capital deepening has no effect on the growth rate of economy or on the marginal product of capital once the steady state has reached. Factors: saving rate, labor force growth rate and DEP rate, the level of output, but do not permanently the growth rate of output per worker. If the economy has not yet reached the steady state, it can experience either faster or slower growth relative to steady state. If the output to capital ratio its equilibrium level, the growth rates of output per capita and the capital to labor ratio are above the steady state, vice versa in case of output to capital ratio its equilibrium. 5.2.2 Implications of the neoclassical model. 4 major groups of conclusions. 1. Capital accumulation. 2. Capital deepening versus technology. 3. Convergence. 4. Effects of savings on growth. Capital accumulation. Capital accumulation affects the level of output but not the growth rate in the long run. Regardless of its initial capital to labor ratio or initial level of productivity, a growing economy will move to a point of steady state growth. In steady state, the growth rate of output equals the rate of labor force growth plus the rate of growth in TFP scaled by labor's share of income plus the growth rate of output does not depend on the accumulation of capital or output. The rate of business investment. Capital deepening versus technology. Rapid growth that is above the steady state rate of growth occurs when countries first begin to accumulate capital, but growth will slow as the process of accumulation continues. Long-term sustainable growth cannot rely solely on capital deepening investment, that is, on increasing the stock of capital relative to labor. If the capital to labor ratio grows too rapidly, i.e., faster than labor productivity, capital becomes less productive, resulting in slower rather than faster growth. More generally, increasing the supply of some input, S, too rapidly relative to other inputs will lead to diminishing marginal returns and cannot be the basis for sustainable growth. In the absence of improvements in TFP, the growth of labor productivity and per capita output would eventually slow. Because of diminishing marginal returns to capital, the only way to sustain growth in potential GDP per capita is through technological change or growth in total factor productivity. This results in an upward shift in any given mix of labor and capital inputs. Convergence. Given the relative scarcity and hence high marginal productivity of capital and potentially higher saving rates in developing countries, the growth rates of developing countries should exceed those of developed countries. As a result, there should be a convergence of per capita incomes between developed and developing countries over time. Effects of savings on growth. The initial impact of a higher saving rate is to temporarily raise the rate of growth in the economy. In response to the higher saving rates, growth exceeds the steady state growth rate during a transition period. However, the economy returns to the balanced growth path after the transition period. During the transition period, the economy moves to a higher level of per capita output and productivity. Once an economy achieves steady state growth, the growth rate does not depend on the percentage of income saved or invested. Higher savings cannot permanently raise the growth rate of output. However, countries with higher saving rates will have a higher level of per capita output, a higher capital-to-labor ratio, and a higher level of labor productivity. 5.2.3 Extension of the neoclassical model. Criticism of neoclassical growth theory. Lack of explanation for economic determinants of TFP. The model predicts that the steady-state rate of EG is unrelated to the rate of saving and investment. Critiques of the neoclassical model led to 2 lines of subsequent research on EG. Augmented Solo approach adds human capital to the production function and enables us to measure the contribution of technological progress. 5.3 Endogenous growth theory. These models focus on explaining technological progress rather than treating it as exogenous. Self-sustaining growth concept with no necessary convergence to a steady-state rate of growth. No diminishing marginal returns to capital for the economy as a whole. In this model, human capital and R&D spending are factors of production and have to be paid for through savings. The production function in the endogenous model is a straight line. The saving rate, the EG rate. Market failure due to plus VE externalities, the private companies invest too low on R&D and knowledge capital. According to this model, the incomes of developing and developed countries should not converge. 5.4 Convergence debate. Convergence countries with low per capita incomes should grow at a faster rate than countries with higher per capita incomes. Absolute convergence of per capita growth rates among all countries but not the level of per capita income. Conditional convergence to same level of per capita output as well as the same steady state growth rate is conditional on the countries having same saving rate, population growth rate and production function. Club convergence: only rich and middle income countries that are members of the club are converging to the income level of the richest countries. Non-convergence trap occurs if necessary institutional reforms will not be implemented. Convergence B/W: developed and developing countries can occur in 2 ways. Convergence takes place through capital accumulation and capital deepening. By adopting technology that is widely used by advanced countries. Endogenous model makes no prediction that convergence should occur. 6. Growth in an open economy. Opening up an economy can significantly affect growth for the following reasons. Funding from global markets. Countries can take benefit of law of comparative advantage. Companies can exploit any economies of scales. Technological progress. Competition leads to better products. Opening up the economy should be the rate at which countries' capital-to-labor ratios converge. Endogenous growth models: more open trade policy will permanently raise the rate of EG. Developing countries have pursued 2 strategies for economic development. Inward-oriented policies focus on developing domestic industries by restricting imports. Outward-oriented policies attempt to integrate domestic industries with those of the global economy. Exports is a key driver of growth. That is all for today. Thank you for watching. We hope this information is useful to you. Don't forget to subscribe to the channel, and like and share the videos. You can also ask the question, we will happy to answer.